Inflation in the United States, that is consumer price index, went up higher than expected by 3.0% in January, which was also higher than the December print and at a 7-month high. Month on month, CPI rose 0.5% after going up 0.4% in the previous month. At the second day of Federal Chair Jerome Powell's 2-day testimony in Congress, Powell continued to respond to concerns about impact of tariffs, immigration issues, Department of Government Efficiency interventions in the Treasury and Consumer Financial Protection Bureau, and sticky inflation. We also bring a clip on the final day from Powell's testimony. Hello, this is Bode Oshosami on Global Business Insights, where we look closer at the main business headlines. To our main story on the latest January inflation print in the US, the data seems to justify and reinforce the cautious posture by the FOMC, that's the rate setting committee, backing expectations that the Fed will likely stay on hold for longer, probably pushing the next cut to as far as September. Not good news for dollar borrowers, even as the haven currency firms up further. Predictably, equity markets tumbled while bond yields spiked sharply higher. Notably, there could be seasonal factors at play, such as minimum wage increases and annual pricing updates. January typically presents firmer readings that tend to fade in the second half of the year. The energy index was up 1% for the 12 months ending January, while the food index increased 2.5% over the last year. Shelter costs, which accounted for about 30% of the entire increase, remained problematic as they rose 0.4% on the month. Same with energy prices ticking up 1.1% month on month as gasoline prices increased 1.8% also over the month. New vehicle prices were flat, but used cars and trucks saw a month-on-month 2.2% increase. Month-on-month food prices also jumped 0.4%, pushed by a 15.2% surge in egg prices as ongoing problems with avian bird flu force farmers to destroy millions of chickens, resulting in the largest increase in egg prices since June 2015. The few categories showing declines in prices included apparel, personal care, and household furnishings. Powell has been saying he thinks the Fed doesn't need to be in a rush to lower rates as it evaluates progress on inflation. Also, the January print doesn't even reflect the potential impact of President Donald Trump's proposed tariffs on prices. Many expect at best a short-term spike in inflation as Trump makes a formal announcement about reciprocal tariffs on every country, which would go into effect almost immediately. We'll see whether this data print influences that decision one way or the other. Some analysts say this puts the final nail in the coffin for the rate cut cycle. Others say the chances of the next move being a hike could now be higher. Powell's wait and see may lead to a hawkish surprise ahead. Back to Powell's testimony, both opposing political interests tried to squeeze out a supporting acknowledgement on the widely divergent positions, but Powell did well not to take the bait as he defended the familiar Fed plot under a cloud of recent data suggesting that so far in the 2025 inflation battle, the Federal Reserve seems to be losing. Federal Reserve Chairman Jerome Powell also signaled no imminent end to the central bank's balance sheet wind-down process, commonly referred to as quantitative tightening. It was perhaps not the best day to be standing before Congress.
The president has certain authorities over tariffs. Congress has authorities over tariffs. The Commerce Department is involved in some ways, but the Fed has no role in setting tariffs. And we don't comment on decisions made by those who do have that authority. We try to stick to our own knitting. In this particular case, it's possible that the economy would evolve in ways that because of tariffs, or partly because of tariffs, that we would need to do something with our policy rate, but we can't know what that is until we actually know what policies are enacted. And remember, it's not just tariffs. There are significant changes to immigration policy, fiscal policy, and also regulatory policy. You put all four of those, and all four of those were things that the President was elected to do. We will then try to make an intelligent judgment about the overall effect on the economy of those, and conduct our policy accordingly. But it's not our role in any way to comment on the wisdom of the policies that are enacted by Congress or by the administration. We won't be focusing on any particular policy, and I can't tell you, what we'll be doing, because it will really depend. It's a fairly uncertain environment right now.
Yeah.
The underlying economy is very strong, but there's some uncertainty out there about new policies. We're just going to have to wait and see what the effects of those policies are before we think about what we can do. So the best thing we can do for Americans is to vigorously pursue both stable prices and maximum employment. We're trying to get back to a long expansion where prices are stable. I would say we're close but not there on inflation. And you did see today's inflation print, which says the same thing. I mean, we've made great progress toward 2%. Last year, inflation was 2.6%. So great progress, but we're not quite there yet. So we want to keep policy restrictive.
And so if there were a decision by the Congress and DOGE or whatever to repeal the CFPB, we could return the consumer protection law enforcement function to other financial regulators.
You could, yes.
Is there a regulatory gap, or are there regulatory gaps that you can see clearly, that people can feel, because there is essentially no CFPB?
I don't think we know where this comes to rest. You may have seen last night that the administration nominated somebody to be the permanent head of the CFPB. So I don't know I'm not sure what the end intention is here. But if you assume that it goes away, then yeah, there would be a gap. There wouldn't be any federal agency that can examine banks above $10 billion, whether they're state member banks or state non-member banks or national banks. That would be the case. But I'm not sure we know what the end game really is here.
Thank you. Thanks for joining us today, Chairman Powell. First, I want to reflect on our hearing on February 24th here in this same room, frankly, via Zoom for a lot of people because it was in the height of COVID. And during my 5 minutes, you felt confident that inflation being at 1.4% would stay under control, and it wouldn't be an issue despite the very large increase in the supply of money. We talked about M2. In a subsequent meeting, frankly, in my office, we discussed Milton Friedman's quantity theory of money in depth, and you believed that it was no longer relevant, that inflation would not hit consumers. We debated asset prices during the hearing, and you claimed that the Federal Reserve's massive purchases of treasuries did not distort the market. Lastly, during the Biden administration, you were actively calling for more fiscal stimulus at times. And at some point along the way, more dollars chasing fewer goods seems to have actually resulted in higher prices. All of these things, inflated money supply, inflated asset prices, inflated consumer prices, happened on your watch. In light of the actual outcomes, have your views changed?
Well, I think we've learned a lot, but maybe not the lessons you think. But I do think we've learned a lot from the situation. We and essentially all of mainstream macroeconomics thought that this would be transitory, and what that meant was it would go away fairly quickly as the supply side healed and as demand came down. And it didn't. It actually did go away, and substantially for those reasons. But it took 2 years.
And to that point, you felt like in the fall that it was going away and things were going to be under control, and you had achieved your soft landing. But the market pretty quickly spoke. I mean, frankly, rates went up over 100 basis points where you guys were going down. And now in today's reports, we see that inflation's actually trending up quite a bit from where it was in the fall. So again, would you, in light of the facts, would you reassess what you're doing with the central planning?
You're right that long-term rates went up, but they did not go up because of expectations of higher inflation. There's no evidence of that. It's actually different things. It's not about inflation.
Well,
You look at markets. Markets are pricing in break-evens. I'll show you the.
So the markets don't believe there's increased risk with massive fiscal spending in the market, and they're not demanding a higher premium because there's more risk.
More risk, yes, but not more risk of. It's not mainly about.
And when you
higher
see asset
inflation.
price inflation and rate inflation, doesn't that result in consumer price inflation?
It's not a question of that. You're saying that the rate increases at the long end are caused by expectations of higher inflation.
They certainly influence the inflation.
That is largely not true.
And if they don't influence the inflation, why do you guys try to steer inflation by controlling the rates? I mean, the reality is you've got pressure, including from the president, to lower rates. Are you going to be able to get lower inflation with lower interest rates?
I think our policy's in a good place. I think inflation has come down from high levels to 2.6% last year. My colleagues and I are holding where we are, awaiting further evidence of inflation.
A lot of the data that you guys are looking at lagged, just like when you said it was 1.4% and everything's fine. I think a lot of people said, it's not fine. You got to go out and talk to regular people. And constituents in Southwest Ohio, just like all over the country, aren't saying they're fine. And they might go that the rate of increase has slowed down a bit, but they know that the prices aren't going down. They're still getting hit pretty hard. And meanwhile, you guys still continue some of these policies. Like you're paying banks still not to put their capital at risk in the market. Interest on excess reserves going back prior to the 08-09 financial crisis, you didn't even pay banks for reserves. Now you're paying them for an unlimited amount of reserves that they want to hold on it. To what extent is that distorting the market by pulling capital out of the market?
None, not at all. You're right, though. People are unhappy about the price level, and that's what we need is several years of real wages moving up higher than inflation. So we don't, we don't have concerns about policies. We just look at the data, and labor supply has actually, the new labor supply from immigration has actually come down quite sharply over the second half of last year, and there's every reason to think that will continue. Demand has also come down, so that the unemployment rate has actually been flat since July. We're going to look at
but would
supply
it
and
taking
demand.
1 million workers out of the economy have a direct impact on
It could. We'll just have to see how supply and demand match up. In any case, we don't. We're not here to comment on immigration. We're here to achieve.
Other business news, the Nasdaq made a small gain on a day marked by a high inflation report and soaring bond yields. The UK economy unexpectedly grew by 0.1% in the final quarter of the year, defying predictions of a contraction and after flat growth in Q3. The annual inflation rate in Germany was confirmed at 2.3% in January 2025, easing from 2.6% the previous month and matching preliminary estimates. UK banking giant Barclays saw its profits up by 24% to £8.108 billion in 2024, just above analyst expectations. It also launched a £1 billion share buyback. Barclays has been implementing a strategic overhaul to cut £2 billion in costs by 2026. Chevron says it will lay off 15% to 20% of its global workforce also by the end of 2026. It hopes to save $3 billion from cutting costs, simplifying its business, and completing a major acquisition. Chevron has faced production challenges, including cost overruns and project delays, now planning to recover by leveraging technology and changing how and where work is performed. Asia-Pacific markets closed mostly higher, much unlike what we saw in Wall Street that fell overnight as stronger than expected U.S. inflation reduced prospects of Federal Reserve policy easing. Well, that's all we can take on this episode of Global Business Insight. Thanks for watching. Bye-bye.